Hello, everyone. We're Group H, and we're presenting on chapters 9 and 10. Here's the team. So first, why is insurance important? It helps provide protection from devastatingly high bills, so medical bills, rebuilding your home after a disaster, or long-term care, and it protects your family after you die. Every type of insurance, though, is not right for everyone. So first, do you even need insurance? So some things to consider: are you single or married? Do you have dependents? Are you the breadwinner of your household? Is the value of your estate more than the estate tax-free transfer threshold? So some key terms listed here, illustrated in this example. So where we have John, a father of two, who pays $50 a month for life insurance because he wants to take care of his family. Because of this, if John dies, his children will each receive 200 grand. So the policy holder is John, the premium or monthly payment is $50. The children are the beneficiaries. The face amount is 400 grand. And the policy states that if the father dies, both of his children will receive an equal share of that 400 grand. So first, now that we've determined whether or not you need it, how much do you need? So first, we have the earnings multiple approach, calculates the lump sum you would need to replace the lost stream of annual income. So in this example, we have Sarah who earns 75 grand a year. She wants her plan to replace 5 years of income if something happens to her, and she's assuming a 5% return. So we plug that into our formula. Annual gross income times earnings multiple is 75 grand times 4.33, and we get our total. So that earnings multiple comes from this chart where you line up number of years you want to replace, which is 5, and the after tax, after inflation return assumed on the insurance settlement. So we're being optimistic. We're going with 5%, 4.33. That's where we got that number from. Now we have the needs approach. Now there's no universal formula for this because it's really just based on each family and what's going on in their situation. So it calculates the needs of the family after the death of the breadwinner and considers the following factors. So, specifically with health insurance, again, the main benefit of health insurance is that it helps protect you from the crippling expense of the healthcare system. They themselves pay a lot in malpractice insurance, and it's a very highly specialized field. So, these are some of the factors that account for the extremely high cost. So, who provides health insurance? You can get health insurance from the government, your employer, or a health insurance exchange. There are a lot of options. Types of health coverage, you have your basic and major medical. There's also dental and eye, which may not be the smartest thing to pay for. You can usually just schedule those. They occur at regular intervals and are sort of less pricey routinely. Next, you have the plan structures. So fee for service, where you get billed directly and the company reimburses you. Managed care, HMOs, PPOs, these are both private plans where doctors and hospitals agree to a pricing system, or you receive all of your healthcare at one location, keeping things pretty simple. So, going further into the types of plans, there's group insurance, which is sold without a medical exam, so sort of a one size fits all deal. But if you want something more personalized, you can get an individual plan after a medical exam. They're also categorized into how you pay. So bronze, silver, gold, platinum, these are all based on how much you pay versus how much your insurance provider paid. And there's also catastrophic, which is an option for if you're very low income or under the age of 30, where you're usually pretty healthy. The Affordable Care Act was signed into law to ensure that healthcare is affordable to a wider range of Americans and improve its quality. There's a range of consumer protections and also requires the coverage of certain essential benefits. There's also government plans, so you have state, workers' comp, federal plans like Medicare and Medicaid. And Medicaid specifically is a joint federal and state program. So that's why it's here in the middle of these two options. You also have some alternative options, FSAs and HSAs, which are tax advantage accounts, which allow you to be used for qualified costs, so healthcare and childcare needs and medically necessary treatments. There's also COBRA, which allows for you to stay on your employer insurance for a limited time, even though you still have to pay for it if you lose your job. And you can also just opt out and not have insurance at all.
Now, I'm going to talk about disability insurance, which is health insurance that provides payments to the insured if income is interrupted by illness, sickness, or accident. The whole purpose is to make sure you can still support yourself financially even if you're unable to do your job. Disability insurance can define disability in different ways. Under own occupation, you're considered disabled if you can't do the main duties of your current job, even if you could technically do another job. For example, a surgeon with hand tremors can't operate, so they qualify even though they could teach medicine. Any occupation has a stricter definition. You're only considered disabled if you can't work in any job that fits your education, training, or experience. So that same surgeon might not qualify if they could still work as a professor. Disability insurance can be short-term or long-term. Short-term coverage usually lasts between 3 and 12 months. Long-term coverage can last until a fixed retirement age or, in rare cases, for the rest of your life. There's also something called a waiting period, which is the time before benefits actually start. This can range anywhere from 30 days to 6 months. Sometimes, if you have a recurrent disability, the waiting period is waived, so benefits start right away. Another feature is partial or what's called residual payments. This kicks in if you're able to work part-time or at a reduced capacity so you don't lose all of your benefits at once. Let's say a surgeon used to earn $10,000 a month, but after an injury they can only work fewer hours and earn $6,500 a month. That's a $3,500 loss, or 35% of their income. If their policy has a $6,000 benefit, they would get 35% of that, which is $2,100. So they'd receive $2,100 from the insurance plus the $6,500 they're still earning, bringing their total monthly income to $8,600. This helps ease the transition while recovering. There are a few other protections I want to mention. Waiver of premium means you no longer have to pay insurance premiums once you qualify for benefits. Non-cancelable terms means the insurer cannot cancel your policy, raise your premiums, or change your terms as long as you pay on time. And rehabilitation coverage means the policy may cover therapy, training, workplace modifications, and sometimes financial incentives to help you return to work. So where do people usually get disability coverage? There are 4 main sources. Employer coverage is often provided as a benefit. It's cheaper but may end if you leave the job. Social Security disability insurance is a federal program, but there's very strict rules and there's no partial benefits. Workers' compensation is state mandated but covers only job-related injuries. And individual policies you purchase yourself, they're more expensive, but they're portable and customizable. Now moving on to long-term care insurance. This type of insurance is different because it's not about your ability to work, it's about your ability to live independently. Benefits usually start when someone cannot perform at least 2 activities of daily living, like bathing, dressing, or eating. For example, an Alzheimer's patient who needs daily help would qualify for long-term benefits. The benefit period is the length of time the policy will cover care services. Options can range from 1 year to a lifetime. For example, if you pick a 3-year benefit period, the policy will pay for up to 3 years of nursing home care, even if you live longer than that. Just like disability insurance, there's a waiting period before benefits begin. During this time, you're responsible for paying out of pocket. For instance, with a 90-day waiting period, you would cover the first 3 months of expenses yourself before insurance kicks in. Because the cost of nursing homes and assisted living goes up every year, many policies include inflation protection. For example, $150 per day could grow to about $200 per day after 10 years with 3% compound protection. Another helpful feature is the waiver of premium. Once you start receiving benefits, you stop paying monthly premiums, which eases financial strain. In summary, long-term care insurance is designed to help cover the very high cost of long-term illness or disability care. It ensures that families don't have to shoulder the full burden, and it helps preserve financial stability while providing necessary care.
So moving into life insurance is only beneficial for people with dependents to be the beneficiary. There are 2 major types of insurance, term insurance and cash value insurance. Term is the best option for most people because it is the most affordable. It pays a benefit when death occurs, but the cost increases at each renewal period. The subtypes are renewable, decreasing, group, credit and mortgage, and convertible term. Cash value insurance is useful for tax purposes. It combines life coverage with the tax advantage savings. This type of life insurance is permanent but comes at a higher cost, and it is tax advantageous because the growth is tax deferred. And then the subtypes are whole, universal, and variable life. Moving into the 2 subtypes of whole life and universal life. Whole life is when the benefit is paid upon death, but a non-forfeiture right is included, and it means the insurance holder has the option to choose the cash value and give up the death benefit. Universal life is a combination that includes a mortality charge, cash value component, and admin expenses, but this plan can often end up with lower than anticipated savings. 3 key concepts of life insurance are the death benefit, cash value, and premium annual payment patterns. The death benefit is either the whole or the term life insurance, and it is just a fixed payment upon death. Whereas the cash value, again, is those tax advantage savings, and you are paying the material higher cost for the tax deferred basis that you're getting. The premium annual patterns refers to the different payment schedules and options that policyholders can choose from. Now, reiterating what Cam explained, there are two approaches for calculation. The earnings multiple is the lump sum that is calculated with the multiple and the annual gross income. The needs approach is interesting because it basically is calculating what you will need to account for when the policyholder dies. Here's an example of just a few calculations where it would be more complicated in a real life example. But if Amy is a single parent with a child, a mortgage, and debt, she needs to account for all of those calculations plus a $45,000 annual charge for expenses and maybe education when the child is independent. So the outcome of this would be that she should consider a life insurance that accounts for all of these charges that she would expect after death. Moving into the contract clauses, there are two different types of contract clauses listed here. The two main ones are the non-forfeiture clause and suicide. Non-forfeiture ensures the value of the policy is not lost if policyholder stops paying premiums after building up cash value. So this basically means if you have to stop, if you cannot afford insurance anymore, you still can get that benefit of the cash value that was built up while you were meeting this payment standard. And the suicide clause is a time-limited exclusion from policy, and the start date is commonly about 2 years after the policy starts. And this just prevents a financial gain from a suicide, so it basically is included in virtually every single life insurance package. There's also a beneficiary provision, a coverage grace period, a loan clause, reinstatement clause, a change of policy, and a premium payment clause. In addition, there are riders or add-ons or options for when you are purchasing life insurance. A waiver of premium is the case of a policyholder being disabled and unable to work. There are often age limits and other stipulations included when this is an offering. And then a COLA, or a cost of living adjustment, means the policyholder pays an added cost for the death benefit to increase with inflation. This is often tied to the CPI, the Consumer Price Index, and basically ensures that if you start your life insurance when you're young and the inflation goes up, that it's still beneficial for your dependents in however many years down the road. And there's also the accidental death benefit, so multiple indemnity and guaranteed insurability, and the living benefits rider. There are many options for settlements that we have covered: lump sum, IO, installment, and the life annuity. But the most important thing is choosing the right insurance plan. Term is more affordable, but cash value may be most advantageous for you based on tax purposes. Using cost comparisons, you can find the premiums less the dividends, or in using an interest-adjusted net cost, it accounts for the time value of money. So it really just depends on what you're looking for and what you think your dependents will be looking for down the line.
Moving on to property and liability insurance. Here's an overview of the four main objectives. So what is property insurance? This allows individuals to pool the financial risks associated with the property losses, such as a fire, burglary, or auto accident, to eliminate catastrophic losses. The importance is that you need to prepare for unlucky and unlikely events. The challenge is deciding how much insurance to buy and what kind. Here's some background. In 1735, the first type of homeowners insurance offered was fire insurance. In 1958, the first modern homeowners policy was sold. Today, in 2025, homeowners policies are sold in 6 basic versions. A peril is an event or happening, whether natural or man-made, that causes a financial loss, and this is included in homeowners policies. Here's a list of package policies. This includes 2 different types of perils: named perils, which cover a specific set of perils. Perils not named are not covered. Open perils, which covers all perils except those specifically noted as excluded. These are the basic policies for homeowners, ranging from basic form to all risk form. These are the packages continued. Here are the 4 basic coverages, which includes all HO policies except for HO4. Coverage A has to do with the dwelling. This protects the house and any attachments to it. If there is an explosion, the garage is protected, but the land surrounding it will not be insured. Coverage B has to do with other structures. This protects other structures that aren't attached to the house and is limited to 10% of the home's coverage, such as a detached garage. Coverage C is personal property. This protects personal property owned and used by the policyholder, regardless of the location of the property. If your home burns down during a party, the property of guest is covered while that property is in your home. Coverage D is loss of use. This provides benefits if your home not be used because of an insured loss. If there is a gas leak and you need somewhere to live, these benefits will cover expenses until your home is repaired. Personal liability coverage protects policyholders and their family members from financial loss if someone is injured on their property or as a result of their actions. This provides protection from lawsuits. There's a minimum level of liability coverage per accident is $100,000. This also covers medical expenses of anyone injured by the policyholder, their family, or an animal they own. There's a small medical insurance policy that covers payments up to $1,000. So if a friend falls down your stairs and breaks their arm, the coverage takes care of $1,000 worth of medical expenses. An endorsement is a written attachment to an insurance policy to add or delete coverage. A personal articles floater is an extension to a homeowner's policy that provides coverage for all personal property, regardless of where it's located. Another type of supplemental coverage is earthquake coverage. This is excluded from standard package HO policies, but important to have if you're in a high-risk area, such as California. Flood protection is different from other coverages and administered and subsidized by the federal government through the Department of Housing and Urban Development. Terrorism insurance protects property owners against losses caused by certified acts of terrorism. After the events of September 11, 2001, the U.S. government established the Terrorism Risk Insurance Act, TRIA. Personal property replacement cost coverage is an additional homeowner's coverage that provides for the actual replacement cost of stolen or destroyed property. This compares to the actual cash value, where it's the replacement value of the property less the accumulated depreciation. Inflation Guard is an endorsement automatically updates your property coverage based on an index of replacement cost that continually updates the cost of building a home. Another type of added liability insurance is a personal umbrella policy, a homeowner's policy that proves excess liability insurance with a protection generally ranging from 1 to 10 million against lawsuits and judgments. So how much insurance do you need? Inflation Guard keeps coverage aligned with rising costs. Replacement cost coverage ensures full value for your possessions, and full replacement is enough insurance for a total loss.
Next is coinsurance. Coinsurance provision is the portion of the claim that the homeowner must pay if they purchase an insufficient amount of insurance. Most homeowners insurance policies have an 80% rule, meaning they'll provide full coverage if the home is insured for at least 80% of its replacement costs or cash value. Here's an example of this. Let's suppose you own a home with a replacement value of $1 million. At the start of a year, a tree falls in your home, causing $120,000 worth of damages. What would happen if you were fully insured or underinsured? Firstly, if you were fully insured, meaning the coverage carried was $800,000 or 80% of the replacement cost. No penalties would apply, and the insurer would pay for all the damages minus your deductible, which in this case would be $5,000. However, if the coverage carried was $700,000, which is underinsured, you would not only be responsible for the deductible, but also the $15,000 in shortfall. Here's a few other things to consider before determining how much homeowners coverage to purchase. Next is insurance credit score, which is based on the same information as a traditional credit score as used in determining home and auto insurance premiums. The lower your insurance credit score is, the higher your rates will be. For example, homeowners with a low credit score on average pay around $2,000 more annually for insurance premiums than those with a high credit score. Here's a few ways to improve your insurance credit score. Pay your bills on time, budget and pay down your debt. Don't cancel long-term accounts, don't take out additional credit cards, and make sure your financial life is in order. Here's a graph that shows the relationship between your credit score and the cost of your homeowner's insurance policy. Those with the lowest credit scores pay over 30% more than the average cost of insurance policy. However, those with the highest credit scores pay over 20% less than the average. It's important to keep your credit score high so you can save money. Going off that, here's other ways that you can keep your costs down with discounts and savings. The location of your home. Homes in low crime areas may qualify for lower premiums. Also, those with less weather risk, think of hurricanes and floods, will also have lower premiums. The type of structure is very important. Homes built with brick, concrete, and other fire-resistant materials may lower costs, and upgrading roofing can save 5 to 35% annually on home insurance premiums. The policy type is important. A lot of people save money by bundling home and auto insurance. Also, selecting the right insurer for you is very important. Compare quotes across different insurers and find the most competitive rate. Also, ask these insurers about available discounts. Here's a few other discounts and savings. High deductible discounts. These work well if you have enough savings to cover the deductible in the case of a claim. Installing security systems and smoke detectors can also be a good way to save money, and they can reduce premiums annually by 5 to 10%. Also, consider a direct writer, shop around, and double check your policy. Making sure your coverage works in the event of a loss. Establish proof of ownership. FEMA accepts the following documents as proof of ownership: deed or official record, mortgage documentation, homeowner's insurance documentation, or a property tax receipt or bill. Use inventory worksheets from insurance companies. These are a list of personal belongings and business assets. It lists their features, condition, and overall value. It can help expedite the claims after a loss of property. Also, record other detailed information about your personal items. Think date of purchase, cost, model brand, serial number, and detailed videos of them. What should you do in the event of a loss? Notify your insurance agency right away, and if it's a burglary or theft, you should report it to the police. You should protect your property from future damage and make temporary repairs. Board up windows, cover up roof holes and wall, and make sure it's safe until an inspector can check it out. Document the damage, and like I said before, use an inventory worksheet and make a detailed list of everything that was lost. Afterwards, you should make sure your settlement is fair. Don't agree to anything less than a fair settlement.
When it comes to auto insurance with standardized policy for individuals or families exists known as personal automobile policy. There are 4 parts. Part A has liability coverage, which has 2 types: combined single limits, which has no separate limit per person, as well as split limit coverage, which separates coverage limits for bodily injury and property damage and per person limits, as you can see in the example. Part B covers medical expenses, Part C covers uninsured motorist protection, and Part D covers damages to your automobile. Here's an example. Sam and his 2 friends were involved in a car accident. They were facing bodily injury damages of $30,000, $2.4 million, and $500,000, as well as property damages totaling $50,000. By adding up each individual's bodily damages, this totals $2.93 million. How much will auto insurance policy pay based on $200,000, $600,000, $100,000 coverage, which is an example of split limit coverage? As you can see, each individual has a maximum payout of $200,000 for bodily injury and a property damage maximum of $100,000. So person one's coverage will be $30,000, person two, $200,000, person three, $200,000, and property damages covers $50,000. So auto insurance policy will pay a total of $480,000. How much will Sam be liable for? Well, total damages here are $2.98 million. $2.98 million minus the auto insurance coverage of $480,000 means that Sam will be liable for $2.5 million. If Sam has an umbrella policy with $2.2 million coverage, how much will Sam be liable for? Well, this means that Sam would deduct the $2.2 million of the umbrella policy from what he was initially liable for, totaling $300,000 if the umbrella policy exists. No fault insurance exists when auto insurance policy covers associated damages and medical expenses, regardless of who is at fault. Over half of states offer no fault system, including Florida. Some common coverage includes medical treatment, loss of income, and imperative costs that are out of pocket. When it comes to controlling auto insurance costs, this can be a touchy subject. What influences costs for auto insurance? Types and use of automobile, as well as location that the auto insurance exists in. Common discounts exist to help reduce costs when it comes to auto insurance, which include accident-free driver, good student, low annual mileage, and multiple automobiles. When it comes to keeping costs down, it's important to keep adequate liability insurance, take advantage of discounts, and pay close attention to the car type, as well as doing your research on websites like Insurify.com. This image here shows the top 5 annual premiums by state, and you can see that Florida is in the top 5, and this information was pulled from bankrate.com as of September 2025. There are some important tips when it comes to filing an auto claim, including obtaining identification of any witnesses and never signing any documents to admit guilt in the moment of the accident. Here are some key takeaways for our presentation today on insurance, and thank you for listening.